Well, thank you, Sam. And just a quick word, a little housekeeping message. As sometimes happens, little glitches occur. And when I first submitted the slides for this program, one of the slides was out of order. Now, it has been corrected, but if you downloaded your copy of the slides before, let's say, 10:30 Eastern today, it may have that out-of-order slide in it, and you might want to go back and, if you're interested in a correct slide deck copy, you can pull it down. It has been corrected now. I wouldn't bother to do it now. You can wait until after the webinar is over. So, why do you suppose we're here? Well, I'm pretty confident that one of the reasons you're here is that you need help with handling return items. And one of the things that I handled when I was in banking more years ago than any of us wants to know about is handling return items for my bank. And we did things a lot differently then than people do them now. For one thing, we actually worked with paper instead of images, and we hardly ever handled a return ACH item. But today we're going to talk about some basic stuff, but we're also going to talk about some of the newer items that you're faced with, and both as a paying bank and as a depository bank, you need to be able to know about. One of the things that we will gloss over is some of the material in the front end of your materials has to do with the Uniform Commercial Code, and it's there in a great deal of detail that I don't want to spend time going over today because I'm fairly confident that you know about this information. I will pick up on a few things, however, in those pages that I think are important. I'd like to spend more time on some of the newer material that hasn't been discussed in previous versions of this webinar. As you know, we are dealing with the Uniform Commercial Code in many ways and some of the things that amend the Uniform Commercial Code. I do want to make sure that you understand that this webinar isn't really legal advice. It's practical advice on how to use the Uniform Commercial Code and some of the other source material to your advantage in being able to protect your bank from returned items, either as the returning bank or as the depository bank. And that's our primary focus today. Some of the things that we're going to talk about and make sure we understand are the midnight deadline, how deposit contracts can affect the losses that your financial institution might incur, and some of the things that you need to know about notices of dishonor. Notices of dishonor are, of course, notices that a check that's been deposited has come back, it's bounced, it's not been paid, it's going to be charged back. Okay, so with that in mind, what we're talking about is guidelines for allocating losses. We're talking about we have some sample forms that are contained within the materials today that are not model forms. They're not forms that have been accepted by any government body or regulatory body. They are forms that have been used from time to time and may be adapted to your financial institution's use. But I do caution you, before going too far with any of these forms, you might want to make sure that they're reviewed with local bank counsel to ensure they're going to address any special local considerations such as state law. Also, any of these examples that we talk about during the presentation assume that we're dealing with the specific facts in that example. Any change of any of the important facts in an example can certainly affect the outcomes. Okay, so we know that the Uniform Commercial Code is a set of laws that has been adopted by the several states, by all of the states, and they are anything but uniform. It's a fact that banks in different states are subject to different sets of rules, but there is uniformity to some degree within the UCC in that most of the states have implemented UCC language that, by and large, tracks the language that's in the proposed or suggested version of the Uniform Commercial Code that is circulated from time to time. There are also things that amend or can expand upon the Uniform Commercial Code. For instance, there are agreements between the parties. An agreement between yourselves as financial institutions and your depositors would be in the form of a depositary agreement, or let's say a stop payment agreement, or it might be an agreement that's imposed on your bank by membership in let's say the Federal Reserve System, or perhaps as a member of a check clearinghouse, for instance. So any of these agreements can modify the Uniform Commercial Code. And, of course, when you're talking about an agreement that your bank has with its customer, usually those modifications are designed to protect the bank because, let's face it, the bank's not interested in losing money if it can avoid it. Now, one of the things that is basic to the Uniform Commercial Code, however, is that when the parties try to agree to amend the outcome under the Uniform Commercial Code, the bank cannot disclaim its liability for the lack of good faith or for failure to exercise ordinary care. So you can't just say, no matter what happens, we're not liable, you're liable, Mr. Customer. There are instances in which if the bank doesn't exercise ordinary care, for instance, the bank is going to lose. You cannot limit the damages for lack of good faith or for failure to exercise ordinary care either. So there are certain bounds within which you can operate when you modify Uniform Commercial Code, but you can't just do anything you feel like. Some of the other agreements might be your signature card. It may refer, for example, to a separate document, such as the deposit agreement I mentioned or stop payment form. It could be a specialized agreement that your financial institution has with some of its customers. For instance, if you have a lockbox set up with some of your business accounts, or if you have services whereby your customer can deposit remotely created checks, or things like remote deposit capture or mobile deposit capture, which is a kind of or a form of remote deposit capture. Each of those services is certainly something where you'd want to at least have a set of specific rules that the customer has to agree to before you'd allow them to use those services, for instance. Over on page 5 in your handouts, there are some other agreements that affect you, specific agreements. There's Federal Reserve Board Operating Circular number 3, otherwise known as OC3, which is the operating circular under which Federal Reserve check services handles checks and images for the check clearing system within the United States. And, of course, it only applies to checks that are handled through the Fed. There's Regulation J, which is a regulation dealing with the use of the Fed for check clearance and for other purposes. There's Regulation CC, which, of course, imposes certain restrictions on a depository bank's ability to delay availability of deposited items with both consumer and business accounts. But it also has some language within it that modifies to some degree the provisions of the Uniform Commercial Code. And then finally, I mentioned earlier clearinghouse agreements, which may change the relationship of the depository and the payee bank with respect to a particular item that's an item of contention, for example. So there are a number of things that banks do that run outside the Uniform Commercial Code. Primarily, we're interested in Uniform Commercial Code Articles 3 and 4.